Hey guys and girls, it's Nathan Burge here from the Be Invested headquarters, and today I'm going to talk about why savers are losers in the current marketplace, why have savers been losing for the last decade, and why savers will be the biggest losers moving forward. Obviously, always like to speak the truth, like to say it as it is, and like to try and change your mindset and tell you the things that the indoctrination camp doesn't tell you when you go to school and keeps you in a little box. So try and open up your mind on a few things. Recently did a blog about two sisters, hypothetical scenario. You've got Sarah and Louise. And apologies for my atrocious handwriting, but we're gonna go and compare the two of them together, and I'll do some very blunt numbers as to how this pans out. So if I look over here with Sarah, she had $100,000, as did Louise, $100,000. Sarah decided to go down the safe road and put her money in the bank. If you go to any banking website, you'll see the average rate is about 2% per annum. We'll just make a little percentage there. 2% per annum for a period of 10 years. She would end up with $120,000. Woohoo! She hasn't even caught up with inflation. She hasn't caught up with the fact that you could have bought a Big Mac 10 years ago for $5, $6, a Big Mac meal, now it's $10, $12. Or you could have bought paddle pops for 80 cents to $1, now they're $2 each. Nor does it take in the fact that your money, your insurance, your electrical, every service industry has gone up as well, which you've probably silently been taxed on. I hear a lot of people out there on the everyday street saying how they're feeling poorer and poorer, and they don't know why. And it's because the silent tax that's in this system that we're designed in is inflation, and inflation is the biggest thing that came out of obviously the GFC. If we come over and look at Louise, she decided to be a bit more creative and buy two properties for $200,000 in Western Sydney. Those properties there, she would have put down out of $100,000, she would have taken an 80% loan, being conservative as we always are. Ideally, those properties would be worth $250,000 using Nathan's buy below market value, make sure there's upside for growth, and make sure that there's a strong cash flow. These properties would have been things back in the day, $200,000 purchase price worth $250, rent for $300 per week, so all the bills would have been covered. You can still do those deals today if you look in the right places. Looking at the marketplace here, the scenario here, 80% means that she would have got a total purchase of $400,000, with an 80% would be $320,000 loan. So I'll just put 320K down here, just to keep it flowing nice and well. She would have used 40,000 times 2 for the deposit. 40K plus 40K, plus then 10K plus 10K for the closing costs. So she'd be into it for 100,000. Those properties, if we fast forward to 2017, would be worth between 400 to 500 each, which would give a total figure of 800,000 to 1 mil. Now, if Louise was to go back to the start and take out her $320,000 loan, and let's say conservatively they're worth 800K, she would have 800 minus 320, which would be 480K as a net figure. So obviously, you've got Sarah over here. She took the nice, easy, simple road. She can't even buy the stuff that she could have bought going back 10 years ago. She did herself a disservice, and for me, I would say that she is a loser, the capital L. If we come over here to Louise, which has a capital L to start a name, she has turned $100,000 into nearly $500,000. And that's using the system that is out there. The system that we're designed in, the money that we have today in our pockets, they may look the same as what we had beforehand, but the whole way that the whole system works is vastly, vastly different. I'm going to do another video, part 2 to this, with an example of how money would have looked going back 20, 30 years ago, and how it looks now, and how if you would go down this road, it would look vastly different to today. Looking at the end result, what's going to happen into the future, quite simply, interest rates can't go up. We're heading into a new economic place, which is very, very exciting, and I see that there's lots of opportunities there for those that are prepared. that educated and understand and can have their head around how they can actually push themselves into a better position for themselves, their family, and the betterment of their lives. We'll catch up soon. Have an awesome day.